Uh, testing. Hello. Okay. Thanks for the upgrade, Oscar. Learn something now on the building side, especially with what is going on today. So let me talk about. Wait for a few people, and then hello, William. Let's talk about. I want to talk about this before I start talking about. Hi, off cue. Talk about the topic. I want to hear what people have to say about that one. Hello, Mayor. One is going So you all heard the news today. Talking about this news. Pyramid. What is a book again? Hold on, hold on. Let me give you the book. Especially with what's going on now. This, I think everyone saw this day, right? Okay. It felt to me like Ronald Reagan rose from the grave. Yeah, but I have to tell you something. I listened to the conference, and it is hold on. Can you see the oh no, you can't see the book. It's this book right there. Called The Black Swan. Um could keep um it's this book, then that book. In some of the in my videos I usually put them at the bottom as a tag. But basically, yeah, so here's my take on this Supreme Court thing. I mean, I don't know if you look at some of my past video, and I had said that there was no way they were gonna basically say that this thing was legal. It cannot be legal because regardless of your political views, the the Court of Appeal basically had said this is not legal, and the reason it's not legal is because you don't have the power to do that. The same way, and I think Trump. I mean, when Biden wanted to basically do away with the what did he want to do away with the students' loan? They said no, you can't cancel those loans. These are federal loans. No, you can't just say you don't pay. So that's not legal either. You can't do it. Now the question is now the market. I believe the market was up. And last time I looked, it was up. In fact, I did some purchase. If you follow me on, if you're one of my members, you know what I bought. Um, because I've been looking to buy this for a while, and this was the opportunity because the market went up. And I always buy what everybody else is selling. Let me see what the saying. Yeah, I mean, the market, yep, the market went up. So the reason the market went up because it says, well, look, no more tariffs. So a lot of the costs the companies were in the process of paying, they won't have to pay anymore. So that's a good thing. And it removes a certain amount of uncertainty. That's a good thing. Yeah, sure, it's a good thing. But what did the president said? He said, yeah, but they never told me what to do with the money. I don't have to pay it back. I mean, I don't know. They didn't say what to do with the money. And frankly, it's a good thing because I'm going to be able to charge you more. I don't know where he's going with that. But that also means that if you are the Fed and you were wondering, well, maybe I should lower I don't know if I should be lowering the rates because of, the tariffs tend to be inflationary. When are you going to say, well, now you could lower the rates because, the tariffs are going to go away. Well, they're going to go away. They're going because they're not going away tomorrow. So therefore, you're not going to be able to lower the rates yet. And if you do it, which obviously the administration is going to push the Fed to do it, if you lower the rates with full knowledge that you're not going to be able to get rid of the tariffs anytime soon, and you know that the GDP is growing. By the way, I talked about this to my members this morning, but out of the G20 countries, G20, the US is the fastest growing country at 4 point something percent. Europe is like 0 point whatever. The US is growing fast. And you're going to lower rates. Well, yeah, because we're going to do it with the tariffs. Hold on. You need to see some data because then I will revert you to my video that I did not long ago, which basically states that we are mimicking exactly the 70s all over again. And so far, it is working out that way. So be careful. This weekend or Monday, the US is going to do something in Iran. That's going to create even more uncertainty. So you got the tariffs, you've got Iran, you've got what's going on with silver and the imbalance. You've got the debt, obviously. Then you have the elections coming up. Then you have the uncertainty about the rate going up. And then most importantly, this market is overvalued. Now, can it go higher? Yeah, sure. But if you look, I think you should see my video on the Q ratio. The Q ratio is saying, you're out there. Yeah. Of course, the Q ratio missed 1987, but usually it doesn't go up like this forever. So in the middle of all this, the big money is acting. I'm going to show you what's going on with Bitcoin right now. Well, I guess Bitcoin is not doing so great because of the prices, right? My members, BTC. Well, Ethereum is fighting a little bit better, but Bitcoin. So Bitcoin's got three things going for it, right? One, fear factor. The fear, not the fear factor. The crypto fear index is like 7, down from 8. I mean, I don't think it's ever been that low. And usually what happens is that when it goes lower, there's a point where it just, time to, and Bitcoin, I think, Bitcoin ended up today 67. Bitcoin. It's 67 when I did my. So it's at 7. Okay. So it's up 1% today. Careful. Don't want to miss that boat. Because when that boat takes off, look at the video I did 2 days ago. When that boat takes off, it takes off fast. I mean, you're not going to get 1,500%, but second, you are very near the bottom. in terms of the cost of mining. I think 59, 60,000. Third, and this is a video that I'm going to do today. I want you to see it first. Listen. You get zero if you're watching it. Yeah, I mean, meaning you don't get to make any money if you don't do anything, of course. But unfortunately, people look at Bitcoin and they say, what is it? Well, but you have to understand what it is. You have to, like everything else, you need to do your homework. I mean, there's no easy way to do it. So let me show you the tariffs. They're gonna do what they're gonna do, and okay, let's take a look at that. Is the smart money double down on Bitcoin? What do I mean by that? So basically, what's happening here is someone has been buying Bitcoin, not just anyone. And I know these guys because one of my former students actually wanted to get a but they're changing. They're changing. Also on BTC now is now. I know. Bound for something. Not too late to get in. Especially, you know, there's going to be. I've looked at Bitcoin with uncertainty in the world, and you say, well, whenever there's uncertainty and especially with the tariffs and all that, you know, if you don't believe in currencies and who knows what's going to come out of the administration, then people tend to go for cryptocurrency because at least you know it is portable, it is viable, it's not worth zero like the other guy says, Michael Burry. So you've got, and especially the way it's been going. Yeah, so we're going to look at what EBIT is doing and MicroStrategy is doing. It's risky not to own some. Diversification flavor. But then again, you have to be comfortable. And this is what the channel is about, right? To understand the risk, to understand the black swan, because then otherwise you don't do anything. Better to play MicroStrategy or BTC, like gold miner versus gold play. But today they were up, both of them. It's moving. It's not going any further down. Let's put it this way. It feels to me like we're reaching a bottom. But everybody has to have their risk. So what if I told you that one of the most sophisticated trading firms in the world quietly are doubling down on Bitcoin exposure through structured accommodation? And what if the way they did it tells us something important about where smart institutional capital believe this market is headed? Let's take a look at this chart that I have. It basically tracks Bitcoin-related asset accumulation by Jane Street between Q3 2025, Q4 2025, and into Q1 2026. The numbers are not small, and they are accelerating. Before we go any further, let's understand what we are looking at. This is a bar chart titled Jane Street Bitcoin related asset accumulation. Jane Street is a premier asset manager. So on the horizontal axis, you see two assets. Hey, Krypton, welcome. iShare Bitcoin ETF, the ticker is IBIT. And then MicroStrategy, the ticker is MSTR. On the vertical axis, you see the shares measured in millions. Now, pay attention to the color coding. The blue bars represents third quarter 2025, and the green bars represent quarter 2025 through February 2026. And so what you're seeing is accumulation over time. Let's start with IBIT, which is iShare Bitcoin. It's an ETF of Bitcoin, essentially. And in the third quarter, Jane Street held about 13 million shares. By the fourth quarter and early first quarter, they had increased of roughly 20 million shares. That is a massive jump. Now look at MicroStrategy. MicroStrategy makes it its business, literally its treasury through Bitcoin. Okay, so in third quarter 2025, they had 16 million shares. And by fourth quarter 2025, first quarter, they are 19 million. Then both position increased. Both increased meaningfully. Both notice something important. The acceleration with IBIT, with the IBIT, was stronger, and that matters. Why? But before we go deeper, I would appreciate this kind of breakdown. Make sure you subscribe. It helps the channel grow. Become a member, obviously, like we have a few members listening. And if you want deeper research, don't forget, read some of those books. If you are serious as well, I would recommend some of those Black Swan books, which focus on risk rather than profit. I rather we don't lose any money, rather we make money. Now let's continue. So why Jane Street matters? Well, Jane Street is not a retail investor. Jane Street is one of the most advanced trading firms in the world, and I could verify that because I know who they are hiring. These guys pay about $100 an hour to good interns. Okay, so they specialize in market making, ETFs, liquidity provisions, quantitative trading. So they see flow, they see demand, they see institutional behavior in real time. When a firm like this increases exposure by millions of shares, that is not random. This is capital allocation based on data. No, here's where it gets interesting. They increase both direct ETF exposure through IBIT and equity proxy exposure through MicroStrategy. So that tells us something, because they own a piece of MicroStrategy. That tells us something, that this is not, they're not bidding on hype. They are positioning across structures. So ETF versus MSTR, which is MicroStrategy, what is the difference? Well, IBIT is a spot Bitcoin ETF. It tracks Bitcoin directly. And if my members knows what we're talking about here. It removes custody risk for institution. It trades like a stock. It's clean exposure. So if you want to get into it, that's a great way of doing it. MicroStrategy is different. It is a company that owns Bitcoin, right? But it also has business operation and it uses leverage. So owning MicroStrategy is like owning Bitcoin plus corporate structure plus leverage. So that creates volatility. So why increase both? Because they serve different purposes. The ETF exposure is direct and liquid. The MicroStrategy exposure can amplify upside during strong Bitcoin runs. It's like having a leverage ETF, which they are. In fact, we were talking about this morning. They basically double the actual movement of the Bitcoin exposure. They have ETFs that do that. That is strategic layering. So in terms of the accumulation pattern, let's analyze the pattern itself. So IBIT went from 13 to 20, which is 54% increase. MSTR, 16 to 19, which is still 16%. But notice a difference. They accelerated ETF exposure more aggressively than equity exposure. That suggests a preference for cleaner exposure. It may indicate, one, institutional flows increasing into ETFs. 2, regulatory comfort rising. 3, structural demand growing. ETF accumulation is often quieter. It is steady. It absorbs supply. And that is why this chart suggests. So what does this mean for Bitcoin structure? Well, when institutions accumulate through ETFs, it removes circulating supply. It reduces volatility over time. It increases price stability during the dips. This is different from speculative retail buying. This is balance sheet positioning. So in terms of risk perspective, let's be clear. This is not a prediction. Again, we're not predicting markets here. We're trying to understand what's happening. If someone could predict perfectly, they wouldn't be telling you. They would just trade it. And this is what this is about: risk positioning, capital flow, institutional comfort level. And that is much more important than guessing a price target. At the end of the day, you don't want to panic. You want to know what you're doing. Because otherwise you say, oh, 67,000, I bought it 80, I should sell. And then before you know it, it's 120,000. Why? Well, because then you listen to the narratives. Don't listen to the narrative. Listen to yourself and your understanding of the risk. Increased structure accumulation reduces downside shock risk unless a true black swan event appears. And that's why understanding tail risk matters. I mean, was it a tail risk today with the tariffs? Not really. You understand risk. If you look at my video from 2 months ago, I think I was talking about the tariffs. There was no way this was going to go through. Although I did say at that time to be careful about the tariffs, because what could happen is, what happened if they had to give the money back? That could have a tremendous amount of implication on the bond market. But if you're not going to pay the money back, then you don't have a problem. So ultimately, what does this chart tells us? Well, it tells us that smart money is not reducing exposure. Exposure is increasing. ETF allocation is accelerating faster than leverage proxy allocation. This is disciplined positioning. This is not gambling. So in closing, hold on, wait, learn, and don't forget to subscribe. And don't forget to understand the risk and read a few books while you're at it. You think recession will come 2030 with the possible BTC not reaching? Wow. We've been asked, they've been predicting recession for I don't know how many years now. And we're talking about all the big guys. You have to realize one thing. You need to understand the situation, right? And you need to forget it's like entertainment at the end of the day, right? If they're telling you it's entertainment, because most people don't understand, but most people don't know what's going to happen. And I know people want to know what's going to happen next. Please tell me. And as you could see every day, right, between 8:30, 8:45 or so, 8:15, I talk to you guys, and you could see the process, right, to go. And we're talking about what, 4 or 5 assets to play around with. And look at the work it takes to try to estimate, to understand, and to see what's happening. And at the end of the day, the most important thing is you need to understand what you're trading. And this is exactly what Warren Buffett says. They ask him, they say, hey, Mr. Buffett, why don't you believe in that diversification? He says, you want me to diversify in stuff that I don't understand just for the sake of diversification? No, I would not buy real estate because I don't understand real estate. And yet people will go online, they will listen to all these pundits, but all these apps, these AI trading bots that are saying crypto is going to go to zero because Michael Burry said so. And he knows because obviously he was able to predict 2008, but he's been negative for the past 2 years. And he's been losing lots of money, quite frankly. Okay. The thing is, if you listen to him and you do what he says, and you say, I thought it was going to go down. Yeah, but because you said it was going to go down. So you have to be very, very, very careful. Especially now because there's lots of balls in the air, literally. And I want to make sure you understand that, because that is quite... it's quite something. Okay, let me show you this one. Talk about retail flow. This thing. This thing. This thing. Careful because it not always, not everything is. So take a let's take a look. BTC drop 50% in February and then bump over 45%. Exactly. I think don't forget this, but there's big players out there making big bucks at the expense of the retailers. Because once it starts moving, it's going to move fast. Feel the pressure building. So that could be very interesting with the next couple. Let's talk about the retail flows. Okay. Look at this chart. I think see it pretty. Okay. So this chart shows something that only happens at extreme moments in markets. It shows that retail investors, everyday investors, are buying stocks at the strongest pace ever. Stronger than in 2021, stronger than 2020, and stronger than most major peaks in recent history. And when something hits the 97 percentile, that means we are not in normal history. We are in extreme history. So let me walk through exactly what this chart shows, how to read it properly, why retail flows matter, what usually happens after extremes like this, and what it means for risk going forward. Again, we're not predicting, but this is about understanding risk. And if you find value, don't forget to subscribe and become a member. It supports that research that we're doing and more frequent analysis. Let's get into the chart. First of all, what are retail flows? Right? Retail flows measure how much money individual investors are putting into stocks. Not hedge funds, not pension funds, not large institutions. This is regular investors buying through brokerage account, ETFs, and trading platforms. So when retail flows surge, it means everyday investors are aggressively buying equities. They fall, it's the other way around. And retail tend to be emotional. Retail chases momentum. Retail tends to buy strength. Retail tends to buy when everybody else is buying, and it sells when everybody else is selling, which it shouldn't be, should be the other way around. Doesn't mean retail is wrong, but it does mean retail often moves in waves. And this shows you those waves. So let's walk through. At the top, it says, as you can see, strongest equity flows on record. And the blue line is key. It represents the retail imbalance, the 21-day rolling sum in billions of dollars. That means instead of looking at 1 day, we're looking at 21 trading days combined. So this smooth out daily noise, right? If the blue line rises, it means retail buying is increasing. And if it falls, it means retail buying is slowing. That's what it means. And if it drops below zero, that means retail is net selling. So now look at the horizontal axis at the bottom to see years 2020, 2021, 2021, 2022, 2023, 2024. The SPAC is near $50 billion in a 21-day period, as you could see. And you could see the bottom is the years 20 to 2026. And you could see it goes from about 15 all the way to $50 billion. That is massive. The red dotted line across the chart labeled later shows we are currently are. And notice the text, currently at 99.7 at the February 4, 2026. 99.7 percentile means this level has almost never happened before. Out of 1,000 observations, this will be among the top 3. This is not normal behavior. This is extreme behavior. In 2020, retail buying surged during the the pandemic rally. In 2021, retail flows were strong during meme stock mania. 2022, flows collapsed as the market fell. 23, retail cautiously re-entered. In 2026, we're seeing the strongest retail buying on record. This is because it is bigger than previous peaks, and that matters. Because extremes often mark important moments in cycles, not always stops, but often late cycle momentum. Retail buying usually accelerates when markets have already risen because, unfortunately, people don't know. They want to be told. They want to know, tell me what happens next. And they tell them it's going to go up, and then they buy. It makes it even higher. But they also do the other way as well. Headlines are positive. Risk feels low, volatility is suppressed, so retail rarely buys at the bottom. Retail tends to buy strength. Why? Because they don't know what's going on. They want to get it on. They want to get onto the bandwagon because confidence rises after price rises. Confidence follows performance. This is human behavior, and that's why I told you, the way to make money, you need to sell when everyone is buying. So, is this bullish or bearish? This is where we need to be careful. High retail buying can mean momentum may continue in the short term and the medium term when everyone is already in, who is left to buy? Markets move based on marginal buyers. If retail has already deployed aggressively, future buying power shrinks. Extreme positioning creates fragility. Not immediate collapse, but it creates vulnerability. So 99.7 percentile, basically what it means, imagine you tracked retail buying every month for 10 years. You saw those readings from lowest to highest. This reading sits above the 99.7 of them. That means it's almost the highest ever. And market can never stay extreme. And they do not stay extreme forever. Extremes tend to revert. Retail's flows are liquidity. Liquidity supports price, but liquidity driven by emotion is unstable. If markets dip sharply, retail can flip from buying to selling quickly. That can amplify volatility. That's what happened with silver, what happened with Bitcoin. So strong inflows increase fragility if confidence cracks. So historically, retail participation spikes near the peaks. The dot-com bubble, the meme stock mania, crypto surges, retail joins strongest when stories feel unstoppable. We must ask, are we seeing late-stage enthusiasm here or early cycle participations? That depends on valuation, rates, liquidity, earnings growth, but the flow data itself signals heat. It's risky. Remember, this channel focuses on understanding risk, not predicting. And right now, flows are extreme, so risk is elevated. You You do what you want with that information, but risk are elevated. It doesn't mean sell everything. It means position sizing matters. So if retail is buying heavily, are institutions selling into that demand? You need to watch this. Extreme inflows can create a blow off phase. Price accelerates rapidly. Volatility drops temporarily. Markets basically follow a cycle. 1, disbelief. 2, hope. 3, optimism. Excitement, euphoria. Retail flows at record levels often appear in the final 2 stages. When the crowd feels safe, risk is usually at its highest. What could trigger a reversal? Well, you could have a rate surprise, be careful, earnings miss, liquidity tightening, geopolitical shock, credit event. I mean, we've got everything going on right now, especially with the tariffs. Now you have an additional. What are we going to do with that money? You're going to give it back? You know where the money sits. The money sits with the treasury right now, which helps with the huge amount of deficit. You send back $300 billion, now your deficit goes back up again. Impacts rates. You have to be very careful. This is a black swan, is a rare event that is unexpected, has large impact, and changes narratives quickly. And extreme retail positioning increases vulnerability to black swan moves. Take that to the bank. And this is the thing, right? The thing is, you don't know what these people are going to do at the administration. You don't know. And you need to make a decision not so much based on what they're going to do, but your understanding of the overall picture. And the overall picture is very risky. Number of YouTubers selling me despite yes hardcore buy and hold forever is a good indicator of the top as well. We might hit anything between 25 to 40,000 by October. Bitcoin you're talking about? Wow. 25 to 40, that's another. Having said that, I had a discussion with the a guy that I know that's a algo trader. He also mentioned that. But you need to understand also that as far as Bitcoin is concerned, there's also a fair amount of that could change things. There's the through Congress there is a new ruling that they're trying to put together that will enable to solidify and make it more compliant to improve the compliance of cryptocurrencies, crypto. So we shall see. All right, let's do one more. Let's take a look. Talk about concentration again. I'm looking. Let's take a look at market cap. It'll be funny. So when this whole thing collapses, we're going to say, oh, look. That's what he said that then. Look at this little guy. You have to understand, you have to be very careful because unlike the stock market, there's a lot of institutional corruption, let's put it this way, on crypto. That moves, they basically taking advantage of the retail investor. I mean, hedge funds do that all the time in the stock market, but then it's kind of it's more, you have a fighting chance. But with crypto, you could be buying tomorrow at 60 and it's 40. Then you sell and then it goes back up to 80. So that's why you need to understand the risk, so at least you're comfortable. What is the cost? For example, the mining cost, the cost of mining a Bitcoin. Where are we with the risk factor, the crypto fear index? Where are we? And what happened in the past when it was that low? Right? What's going on with what's going on with the buying, the regulations? Who's doing the buying right now, right? You need to put all these things together, which I've done for you. And you have to kind of like, okay, so does this make you comfortable? Or does this make you scared? Basically, that's what it comes down to. And unfortunately, when people don't understand, they want to be told, well, then, what do you predict is going to happen? Sure, if I'm going to tell you everything is going to collapse, then you're going to want to listen and say, what do you mean? Nobody knows. But at least you want to be informed. Otherwise, you will be taken advantage of. It's not a good feeling. Let's take a look. Look at this chart. This chart explains almost every major market bubble over the last 100 years. It connects the Great Depression, the Nifty 50 era, the dot-com bubble, the global financial crisis, the COVID surge, and right now. And again, this is not about prediction. It's about the risk, because if you understand concentration, you understand fragility. And if you understand fragility, you understand what breaks first when stress hits the system. So before we go deeper, let's take a look at the chart. And most importantly, don't forget to subscribe and become a member. And I will put a book for you. Pretty good book. That I want you to read. And it'll be this little guy here. I'll put as a tag later in the video. So let's take a look at the chart. The title says market cap of the largest stock relative to the 75th percentile stock and weight of the top 10 stock in the S&P 500. It looks a bit complicated, but it's not. It's been simplified for you. The left line, which is the blue line, basically this line shows how big the single largest company in America is compared to a normal large company. If that number rises sharply, it means that one company is getting huge compared to everyone else. When the number spikes, dominance is extreme. The right line, which is a gray line, that gray line shows something different. It shows how much of the entire S&P is made up of just the top 10 company. So if that gray line rises, and you could see it kind of go along with the blue line, it means the index is becoming concentrated. Right? It means that basically the value of the top one is the top 10, and the small group is carrying the entire market, which that's what we've heard. And look at the time axis. It starts in 1925, right? All the way to the left. And it runs all the way to today. So that's 100 years of market history. And notice something very interesting. Every major spike lines up with a famous bubble. Okay? And that is not random. Look at the Great Depression spike. Look at the first major spike around 1930. The blue line explodes upward. This was the era before the Great Depression. Back then, a handful of companies became extremely dominant. Speculation was wild. Optimism was extreme. The concentration reading reached levels that were unsustainable. And then the collapse came. What's important here is this. Concentration didn't cause a crash, but it revealed vulnerability. When markets depend too heavily on a few names, they become fragile. They made a book. They wrote a book about it. Now move forward to the 60s. You see yet another major rise. This was the era where investors believed certain companies were untouchable. AT&T, General Motors, IBM. People thought you could buy them at any price and hold forever. They were called one-decision stocks. Just buy, never sell. Sound familiar? Concentration rose, valuation rose, confidence rose, and returns after that period flat for a decade. Again, concentration marks the top. Then you had the Nifty 50. In the early 70s, same story. A small group of must-own growth stock. Investors paid extreme prices. The market became top-heavy, and then the bear market of 1973, 1974. Then, of course, you have the dot-com, 1999 to 2000. This spike is massive. The blue line shoots up. The blue line shoots up. The gray line rises sharply. Tech dominance. They dominated everything. Cisco became the largest company in the world. Microsoft dominated. Investors believed growth would never slow, and the index became highly concentrated in tech. Then came the crash, and the Nasdaq fell nearly 80% over 3 years. It took 15 years to get that money back. Many stocks never recovered. Again, the spike in concentration came before the unwind. And of course, then you have the global financial crisis. Because the 2000 crisis wasn't about tech concentration, it was about credit, it was about leverage. But concentration still rose somewhat before that period. Then you have COVID. The 2020s. Look at the gray line. Look at the blue line. Both are rising sharp again. The top 10 stocks, they make up more than 1/3 of the S&P 500. This is extreme. This is the Magnificent Seven era. Tech dominance, AI dominance. The entire index moves. So why concentration matters? When markets are diversified, weakness spreads slowly. When markets are concentrated, weakness spreads instantly. If one dominant stock falls sharply, then the whole thing falls with it. As they rise, they receive more flows and push them higher. So that doesn't mean we should sell everything, but it doesn't mean that there's a crash tomorrow. But what it says is that risk again is elevated when leadership is narrow. History shows that extreme concentration rarely lasts forever. Mean reversion happens, that basically mean that ultimately we go back to the average. Sometimes slowly, sometimes violently. So finally, what I want to say is this. The most important investors in history did not try to predict dates. They measured risk, they studied the structure, and this is what this chart shows. It shows that today's concentration level are historically high. When history rhymes, it often rhymes through structure, not headlines. So ask yourself, if the top 5 or 10 stock posed, what would the index do? That question matters more than any forecast. And don't forget to check my any Black Swan book that I'm offering you, so you get to learn a little bit things, a thing or two about a thing or two. So this situation, since 1982, distribution of wealth in the U.S. increased by a factor of 25 in favor of the top 1%. Yes. The question is this, ultimately, right? We all want to know what drives the market. What drives these people to buy and what drives these people to sell? What drives the silver market right now? I think I'm up that position. I'm talking to my members there. That position that I've been following. Oh, one of my students is over at the Captain Ethereum. There's a huge conference on the West Coast. I'm going to have her on. Yeah, so basically, so silver. So this position that I have with silver today is up 23%. You know the one I've been talking about every morning? It's up 23% today. No, not today. Overall. Today it's up 16%. Time to get out. Well, because 30% return in 1 month. I mean, how much you want? 5,000%. But once you understand risk, it works. There's volatility. This is how Spitznagle made 4,000%. Like I said, with I don't have a book with Spitznagle. I did have one. The Dow. It's called the Dow Principle. DAO, DAO, not DOW. And basically, what they do, they don't try to predict the market. They know that there's risk, and they'll hedge all the time. Fantastic. If you know what you're doing, you understand risk, obviously. That's how our dear friend Michael Berry made money. Yeah. What did he do? Well, he basically hedged the market. He hedged that there would be the credit default swap would collapse. That's what he did. And he did pretty good. So what drives stocks? It's all these people. It's psychology, most importantly. It's impossible to predict. I mean, I'm doing some research in terms of in the math, and some of you know what I'm talking about. Looking at ways observatory that are looking at math-driven algorithm that can predict, or at least the same way you would predict an earthquake, essentially. There's a way of doing it. That's how you do it. But everything else becomes so complicated, people don't understand. And if you don't understand, they're not going to tell you about it. They're not going to tell you that on Bloomberg. They're not going to tell you that in the Wall Street Journal, because you're going to read it and you say, what? I don't understand anything. When you not buy, you don't read, and they want you to buy and read. So okay. All right. I will see everyone, I guess, tomorrow.